Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending December 3rd, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is Where's Santa Claus? Well, everybody was expecting a Santa rally. So far, we've had nothing but coal in our stockings. Let's take a look at kind of where we are, where we've been, and kind of where we're going. So if we just take a look at the index performance and take a look at the market this past week, you can see everybody's in the red in the US. The Russell's leading the way to the downside, whopping 4.26% to the downside to be exact. Year to date, everybody's still in the green, but the Russell's trailing. And if you look in the upper right-hand corner, you can see the forward PE ratio sitting at 21.42. It's still relatively high, okay? Dividend yield is 1.31% for the S&P. Treasury is 1.34. Closed there at Friday. But look at the earnings yield for the S&P. If you take the earnings per share estimate through the end of this year, we only have about, 4 weeks left. It's going to be a little over 205. Markets closed around 45.33 on Friday, so the earnings yield is a whopping 5.51%. So if you look at that over the 10-year Treasury, which is considered the global risk-free investment, that's 4.16%, folks, almost 4.17, which basically means money is going to want to continue to go into the S&P, especially with interest rates. Even they're talking about raising them, still extremely low. If we look at the VIX, well, guess what? Last week it closed at 28.62, which was high, but it even beat that number. This Friday's close at 30.67, up 7.16% for the week. Best sector is the equities proxy for a bad market environment, risk off. Utilities came in first, 96 basis points, almost 1%. The worst performing sector for the week was communication, 3.21%. Annual sector performance, energy still on top. This was a horse race. Energy's been in the lead every month except for one, I believe. Staples bringing up the rear, but notice it's still in the green, 8.04%. Now, if we just take a look at some of the sound bites from the data this past week, and we look at this, we saw non-farm payrolls come in at about 210,000 this Friday, well below the 546,000 that folks were expecting. Okay. The bright side is they did revise up prior numbers. They brought up October, not by much, maybe 15,000. September, they almost doubled that one, a couple 100,000. So they did revise prior. So I suspect this one here at 210 is going to be revised in subsequent months. But either way, it was a disappointing number. Unemployment rate did improve by 40 basis points. It came in at about 4.2%. The prior month is 4.6%. So it dropped 40 basis points. So it's not bad, right? Average hours worked also ticked up. Now, if we look at this, we look at the Treasury market and the Federal Reserve. Well, Jerome Power Ranger Boom Boom Powell, our illustrious Fed chair, kind of acknowledged in testimony this past week here in the U.S. Congress and Senate Banking Committee that inflationary pressures, he's still betting that they're going to come back down next year. I would agree with him to some point, but they're a lot higher than he expected, including the rest of the board of governors that have voting power with the Fed. Okay. So that means that he also says he's considering accelerating the pace of the monthly bond purchases. Right now, they're purchasing 105 billion. They're going to drop that by another 15 billion in the month of December. And they'll be down to 90 billion remaining starting in January. Now, I suspect they're going to take that up to 30 billion because a new voting member of the Federal Reserve, I forgot his name, but he came out Friday and made a statement early in the morning, which, by the way, helped push the markets down even more because he's going to have a vote next year. And I imagine a lot of the other Fed governors are thinking the same way. He basically said that we're going to increase and accelerate our quantitative tightening to try and end it earlier in the year. Remember, they were looking at ending in the summer. Now they're talking about the end of March or early April. And he also threw out there the wild card statement that we may even raise rates. We're not opposed to raising rates while we're doing quantitative tightening. Folks, understand, if you understand quantitative tightening, that also has a direct result of raising interest rates. Okay, members, we've talked about it a number of times, and we've got to follow this very closely because could have some consequences for 2022. Okay, so that's kind of what we're seeing now. Of course, if we go over to Europe, let's just take a look at where we are in Europe. Over there is a mixed bag. We had the Euro stocks, the 50 largest companies across Europe, basically in the red, not by much. Year to date, they're doing fairly well. The DAX was the other major driver of the bus all across Europe because wherever the German economy goes, most of the rest of Europe kind of follows suit. They were down for the week, 57 basis points, so not much. Both of them are up solid in the green. In fact, the FTSE and CAC 40 are also solid in the green year to date. They were in the green a little bit this week. The CAC 40 is leading the major indexes across the planet, up 21.87% for the year, just slightly ahead of the S&P, which is at 20.83%, as you can see. Okay. Now, over in Europe, they're getting a lot of negative headlines, and this renewed surge in this COVID variant is prompting countries like Germany, Austria, Spain, Portugal, and others to tighten restrictions on those unvaccinated people. In fact, they're even doing mandatory vaccinations. They're closing down more restrictive lockdowns. All of this stuff, these knucklehead politicians, I guess they'll never learn. But what's going to happen is they're going to drive the European economy even lower. That's why the U.S. is probably going to overtake them unless the politicians here go batshit crazy like they're over in Europe or in Australia. Inflation in the Eurozone also accelerated to its highest level since the currency was introduced, the euro, in 1999. I was over in Holland at that time. So that was really amazing. Consumer prices rose at an annualized rate of 4.9% in November. That was up from 4.1%. So an 80 bip rise in the month of October. A lot of it is due to energy costs. They're having huge energy problems over there. Hopefully we won't follow the European Union and how they manage energy with what we're doing here, but Sippy Cup Joe seems to be taking us down that path. Hopefully he'll be stopped. Retail sales in Europe also rose 20 basis points. It dropped the prior month. So, the consumer over there, sentiment is weakened a little bit, and if depending on how long they stay shut down, it could make it a little bit worse. Okay. So that's kind of what we're seeing there. Now, of course, if we go over and shift our view to the Asian markets, you can see the Nikkei was down for the week, over 2.5%. Year to date, it's just barely above zero at 2.13%. Okay. And in Japan, there's still a lot of concerns about the Omicron variant, right? So their prime minister over there, the new one, Fumio Kishida, they announced border closures the end of November, going into effect really early December 1st, or December 1st, I guess. And even with all of that, the industrial production in Japan rose 1.1%. Okay. Unemployment rate also dropped a little bit lower. And a lot of these economic data points don't affect most of the planet the way Europe and China do. But either way, it's important to understand where China or Japan's going because they're the third largest economy. And sometimes you can get a heads up on what's going on in some of these other Asian markets to help us understand better what's going on in Europe and of course over here in the US. So that's what's happening in Japan right now. And then of course, if we look at the other Asian big player, which would be China, you can see they were up for the week 1.22%. Year to date, just barely above zero. Now that if I include more Chinese stocks, it would go right into the red again, right? So just understand China's not having a good go of it. Hong Kong, the Hang Seng Index, down for the week and really in correction territory year to date. Okay, now in China, there's a lot of tension between U.S. and China. A lot of things going on underneath the surface right there. I think just this past week, the Chinese ride-hailing app DiDi said it would delist its U.S. shares from the New York Stock Exchange. Okay, keep in mind we may see more Chinese stocks delisted, so you do not want to be holding. And I've told our members you don't want to be holding Chinese stocks, BABA, those kind of things, because if they're delisted, I don't know how they're going to react to it. You're going to see some stocks cut even more. They're already down a lot, but they could get even worse, like JD.com. Alibaba, those kind of things. So be very careful. The other thing is The manufacturing, the official government released PMI data rose to 50.1 in November. It was at 49.2 in October. So let's just say anything over 50 is expansion, anything under 50 is contraction. So it's borderline, okay? And a lot of credit analysts believe that China's government's going to have to step in and issue some kind of policy response because the property sector over there still sucks, right? There's more defaults coming by some of these big property managers, and it's starting to spread into high yield bonds, into the going from the high yield bonds rather into the Chinese investment grade bonds. So that can roll over quickly into the domestic market, and I do not think China wants that to happen. So they're going to step in probably. Now, the big difference between, you may be saying, well, if the Chinese real estate market's crashing, could the same thing happen here in the US back in '08 and '09 when our real estate market crashed? And there's a big difference. The biggest difference is in '08 and '09 when we securitize all those mortgage loans and then we package them together via gurus at investment banks and so forth. They sold all those packages. Not only the U.S. pension funds and hedge funds and others, but they also sold them overseas, both to Chinese, Japanese, Asian markets. They sold them European markets, everything. So when the markets crashed in the U.S., everybody was holding bad debt. Everybody. China's different. They don't go out there. They don't have a developed treasury market like we do or a bond market. You know, they're just trying to get that going right now. So all of their bad debt was held by a lot of Chinese citizens. Some hedge funds, some US based hedge funds and banks, but not many, right? And not to a large degree. So even if that goes kaboom, then it's not going to affect us like the '08, '09 crash, right? It will affect the Chinese citizen. And then that could in turn have some corollary effect in Europe and the US. So we have to be careful for that, but it's not going to be as big of an impact, right? That's why the markets haven't really, focused too much on it. And you haven't heard a lot of the TV folks talking about it very much, right? Now, one other chart I want to show you here, which is really interesting, a little bit of a macro perspective. Let's just take a look at this. You can see, I think I've shown you guys before, I update it every Friday at market close. You can see here, I've broken out since 1920 decade performance by the S&P. You can see in the 20s, right before the 1929 Great Depression, we only had one bear market. The markets finished up 131.7% for that 10-year period, 1920 to 1929, December 31st, 1929. The markets crashed though, so going into the 30s, the markets are dealing with the Great Depression. Notice there are 9 bear markets in that 10-year period. The markets finished down 39.50% for that entire 10-year period. And then even in the 40s, there were 4 bear markets as a spillover, and it only finished up 33.20%. And then we were off to the races in the 50s after the World War II, okay? And then we were off to the races. And then in the 60s, things started to get really ugly again. And then we had the stagflationary 70s where interest rates were 18, 19, 20%, the Carter years. You guys remember that? 2 bear markets across those, but look at the performance for a 10-year period. 17.8% in the 60s and 4.8% in the 70s. Still in the green, but I mean, just really horrible. And then the 80s and the 90s, everything was just go, go, go. Reagan came in the 80s and kind of flipped things around, and then Clinton took him in the 90s. And everything just took off. In fact, in the 90s, we didn't have a bear market at all. Things got a little bit exuberant. We had the dot-com bubble in the 2000s, and we had the '08, '09 financial crisis. So we had 4 bear markets in that decade, and the markets actually finished down minus 9.30%. So we had 2 major calamities in the U.S. that time. And then we're off to the races again in 2010, and then we're just kicking off the 2020s with January 1st, 2020. And then we had COVID hit. That gives us that 1 bear market so far in this decade. And January 1st, 2020 to Friday's close, we're up 40.31%, right, when you toss everything in. So if you look at it on the far right, you can see the average per decade is to finish about 10.3.49%, or an average of about 10.35%, averaging about 2.3 bear markets per 10-year period, or per year, you got a 21% shot roughly at hitting the bear market, right? Now, again, these are just stats, but it goes back a long period of time, and you can see there's generally a bear market or two. On average, there's an average of 2.3 bear markets every 10-year period. So if you do the math, that would be every 4 or 5 years you get a bear market. Now, if you take out this COVID black swan event that we had here last March, we didn't have a bear market in the 2010s. So if that not have occurred, we would be due some really ugliness, right? So I just wanted to throw that out. We've had 26 bear markets since 1920, kicking it off. So bear markets are normal, guys. Just understand that. And then you have the reset, and then people come in and buy the dips again. The smart people, traders, our members, folks that understand the markets. Now, I wanted to put this up there to let you know that we're going to see some differences in 22 and 23, right? 2022, 2023. It's going to be a really interesting market. For our members, we'll have a lot of fun. Some of the best deals that we did, some of the most money we made was in 08 and 09. Remember, the markets generally go down about 4 to 5 times faster than they go up. So it offers some great opportunities if you know how to trade a bear market. Now, what I want to do is I'm going to shift you over here, and let's take you to the E-mini S&P 500 futures. And let me just show you a couple of charts, and we'll wrap it up for this weekly update. So what's going to come on the screen here very shortly here is, as I said, the S&P 500 E-mini futures. Okay. So as you can see on the screen here, I've got a number of things going on in this chart, kind of an active, busy chart, but let me just kind of go through it and explain some of the things to you so that you get a better flavor for it. So if you look at it, you can see this bright colored bar, which was my estimated stop, our resistance point. And I put this up when the markets are around 42.50, actually before that, right? So I had this up here, and I'd said our range for the end of the year is going to be 4,600 to 4,750. Right? I said that would be the range of where we would finish the end of December. We got up to 4740.5, right? Missed the upper end of my range by 10 points. The lower end of my range was 4,600. Now, I'm not really big for just using the 8-ball and shaking it up and just making a guess out there, but it just looked like the charts seemed to want to go there. And I did say that we should have a 2 to 4% dip. Right now we're down a little over 5% given the pullback that we've had. Notice that yellow circle and that light blue colored circle right there. These are just estimated pullback points to give us an Elliott wave 4. This is an Elliott wave 3, which is an impulse wave. And then you typically have an Elliott wave 4. Sometimes it could be a really classic, just straight down, kind of a slow straight down. Sometimes there's so many different patterns to an Elliott wave 4, which tends to be the hardest pattern to read, but it does seem to consolidate and then move up to a final Elliott wave 5. So I do believe we can go higher, but the big snake eye to all that is if the Omicron variant sticks around and then the governments here or the politicians here do really stupid things, like they're doing in Europe and Australia, where they start shutting things down. The market's going to account for it, and they're going to start cutting the price even more. All right. Remember, our PE ratio is sitting around 21 and some points, and without that, and they're going to start reducing the forward projections. They're gonna cut them down. So instead of 21.42, they may cut them down to 18 or 19. And to get to 18 or 19 forward PE ratio, price to earnings, then you're going to see this market drop another 200-300 points very quickly, at least in a correction mode. That is the wild card in all of this. But assuming Omicron variant, and we're going to know in the next week or two if it's very dangerous or not. If they come back and say it looks like we've got a cure for it, it's not as deadly as some of the others, then I think you're going to see the markets bounce back pretty hard, and we'll have a strong finish to the year. So right now, this is where we are with the markets. If we do look at the Nasdaq, right, same thing. Both of them, Nasdaq and the E-mini S&P 500, broke the 50 EMA. So the upside is I want to see us regain that 50 exponential moving average. Both of them are down about the same. Nasdaq down just a little bit more. Okay. If we look at the Fang Index, which is a customized index I put on my eSignal, you can see it's comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. Apple is probably one of the better performers, and as the markets start to create this topping pattern, you're going to see those that hold up best are tech stocks, mega cap stocks that have really great cash flow, strong cash on the balance sheet. That would be Apple and Microsoft. Okay. So even though they can go down 15 to 25% pretty quickly in a bear market, even in a correction, they can go down 15%. You'll see buyers step in there unless we get a change in the sentiment of the market. That's what you could possibly expect if we get a correction. I'm not calling for that right now. I'm calling for anywhere from a 2 to a 5, which we've already hit. Maybe another couple of percent, but I don't see much more than that unless we get some different news out of the wire services. That's kind of what I would expect. Okay. If we look at the ratio chart here of the SPX to the equal weight SPX, you can see it's been going down. That means that in general, the general S&P that's equal weighted per share is doing better than the SPX normal, because the SPX normal, remember, Apple controls just Apple alone controls 5 to 7% of where the SPX goes, and you only take about 5 stocks, and that controls probably 18 to 22% of where the SPX goes. Just 5 or 6 stocks, most of them big mega cap tech stocks. Okay, so if you make every stock equal to 1% of the entire S&P 500, then those guys lose their weighting. So what this means is these guys are being sold off right now, probably collecting and saving profits, protecting profits before we get to the end of the year. And then we have a reset in January because everybody runs on a calendar basis here. So I think a lot of this is a combination of profit taking, some of the Omicron variant, but I think a lot of profit taking as well. Okay. And then, let's add to that the Fed coming in here. I mean, the markets already had forecasted they were going to probably raise rates sometime in the summer one time, and they were going to do some quantitative tightening, but now this Fed governor threw the added bonus in there of, well, hell, while we're doing quantitative tightening, we can also discuss raising rates. So that's scaring the markets. What that means is every week when we get our employment numbers, our CPI data, and everything else, the market's going to be watching it very closely. Okay. So just keep that in the back of your mind. Now, if we look at the general index fund for all world, look at it. It's down here very ugly. I mean, we're nowhere near the highs made. This is the Vanguard Equity Index All World Fund. So the rest of the planet is not doing as good as the U.S. We're down near flat for the year for the All World Fund, right? And then, of course, if we look at emerging markets, that's not that much better either. We're in the red. We're down near the 2021 lows. To give you an idea of just how ugly the emerging markets are right now, let's just take it and I just run a plumb line down here, and I'll take it right down here. We're down about 9 point. Oh, shoot. I mean, I got to get so I can read the darn thing, right? That would be a fair call. So if I come in here and just run this straight down, roughly, we're already in correction territory. We're down about 16%. Not in bear market yet. Our low for the year is 16.76%, and we're right down around the low. Okay. Now, if we look at the tracking stock for China, now the one that I showed you are some of the largest companies in China. But if we look at the tracking stock for it, just so that you can see where it's going, you can see here, we're still underwater, right? Not as bad as before. We were almost in a bear market when Xi went after all the tech and educational companies in China. But if we look at it, China's down about 15.96%. So emerging markets, that ETF comprises about 33%, 32, 33% of Chinese stocks. So emerging markets is having a hard go of it, really is. Europe is doing fairly well, right? Because they got hit so bad last year. And if we come down here and we look at Treasury market, now let's just look at the bond market here for a second. If we look at the bond market, you can see here, big move higher. And if we look at interest rates, we'll look at the 10-year, big move lower, right? So you may be saying to yourself, why the hell is interest rates going down? Aren't the Feds talking about raising the rates? That doesn't make sense. Why would the rates go down? Well, understand a couple of things about the 10-year and the 30-year interest rates. Let me show you the 30-year. That's the 10-year. If we look at the 30-year, let's go out even further. Look at this one. It's down even more. Okay. So why are the rates going down? Well, understand when you get out to 10 years and certainly 30 years, it's not a vote of where interest rates are going. It's a vote on the future direction of the U.S. economy, 2 years, 3 years out in time. And because they're going down, the index is basically saying there's not going to be a lot of money made in the U.S. markets, in the index markets. Now, what interest rates are going up are the 2 year, okay? Because the 2 year and shorter duration Treasury notes are more affected by the Federal Reserve and raising rates. So what does that mean when the short end of the curve is going up and the back end of the curve is going steady to down? The yield curve flattens because that's the difference between the front end of the curve and the back end of the curve, like a seesaw. And when it goes down or it gets flat or goes down negative again, that is not a good sign, folks. Banks don't like it. Risk on assets don't like it. So you're going to see money in 2022 kicking off looking at, we got to be a stock pickers game. I got to look at companies that have great balance sheets. I got to look at companies that have a good story, good management, execution team. Possibly paying dividends more because you're going to see money do that. Remember, the earnings yield in the S&P is at 5.51%. They're earning over 4% more than a 10-year treasury. And with these 10-year treasuries going lower, where do you think money's going to want to go? It's going to, pension funds, all these hedge funds and everything, they're in search of yield. So they go into these things. That's what's causing this dichotomy right now. Now, understand one thing. The fear with all of this is what happens. What do you call an economy that has rising interest rates? Rising inflation, and then short end interest rates going up a lot higher, and yet the economy's stuck in neutral to going down. That's stagflation, guys. So that's not a good sign. That's even harder to get out of than an inflationary environment. So we got to be real careful with this stuff, right? And that's why there's a lot of risk in this market, not near term. I think near term we could have another Santa rally or an end of year rally or into January, assuming we don't get any of these unexpected newswire events. Outside of that, we got to be very careful, okay? So that's a little bit of what I'm seeing right here. Members, I'll go over volatility and the currencies with you in our Sunday weekly market watch tomorrow evening. If you're not a member, I highly encourage you to come in and check us out because, it's just, you want to be here. Trust me. If we look at gold, you can see gold. I tried a little bit of a breakout here. I think longer term gold is going to go higher. Short term, I think it's just in a major chop mode right now. Okay. So I'm not doing anything in gold at this time. Copper, same thing. Copper story is a lot about EVs, electric vehicles. They use about 40% more copper than gasoline powered vehicles. I got everybody in copper way back here. Okay. Right here in early April is when we got long copper. It was a great trade. Made a lot of money in copper. And you could trade an ETF that tracks copper if you don't like to trade futures. But either way, it was a great trade. Made some really good money on the trade. And then once we had that kind of a blow off top, it's just a long-term consolidation mode. A lot of this is driven by China. China's having problems. I mean, they're the largest buyer of copper, so much so that they have a copper reserve. They got an oil reserve. We got a strategic oil reserve, but we don't have a strategic copper reserve. China does, and they're cutting back big time on buying copper because a lot of that went in their buildings and infrastructure, and they're cutting that big time with the real estate problems they got. So it's being made up in the slack with EV vehicles, but that's going to take a little bit longer time. So meanwhile, copper is very choppy. What was I going to say? Chopper's very copper. I promise I don't have Red Bull in my, I don't have vodka in my Red Bull. I'm getting that backwards too, guys. So anyway, that's kind of what I'm looking at there. And then of course, finally, I'm going to wrap it up looking at oil real quickly here. If we look at oil, every move higher, I've basically been saying we got to fade this move. This move here, and this move up here. Every one of them, I was having our members fade the move. Now, how did I know to fade that move? Well, I've reviewed it with the members. I've just briefly talked to you about it, but we have a retest to the high. And when the retest fails, then you just immediately go in and fade the move. And you can keep your risk very low. And then if you get it right, you make some serious money because oil pays out a lot of money, especially if you're buying puts in the oil market, in the oil futures market. But there are a number of different ways to trade oil. And we can trade the crack spread. We can trade the Brent crude over West Texas Intermediate, WTI. We can trade those, the difference between the two. We've done those trades before, done very well, as well as a number of different ways to play oil itself or some of the oil majors. So that's a little bit about where we're sitting right now, everybody. Otherwise, enjoy the remainder of this weekend with football games and everything going on. By the time you see this, it'll probably be on a Sunday with pro football. But enjoy the weekend, members. I will see you this Sunday evening for our weekly market watch. Other than that, have a great weekend, everybody, and I will see you guys later. Members, tomorrow night. Ciao, everyone.